Hello, everyone, and welcome to our webinar today, where we're going to be talking about tax specialty updates. This webinar is part of our year-end planning series, so all of the content today is going to be delivered with the lens of analyzing potential opportunities for you and your business heading into 2025. It is delivered sort of as a quick fire just panel discussion. And so there's not going to be too much time with each of these folks, but we are excited to sort of give you a look into all of their different worlds and potential opportunities for you. My name is Iris Laws. I'm going to serve as your moderator today. And taking a quick look at the different topics on our agenda, we're not going to have long for each of them. And so what we would encourage you to do is to drop any questions that you might have in the Q&A. Our panelists will be responding to those throughout. And then if there are any leftovers that are unanswered, they'll be circling back after. There will also be an opportunity to go in and request a meeting or a follow-up discussion with them at the end, the last polling question in our deck here. So without further ado, I'm going to go ahead and kick it over to our first panelist. Her name is Brittany Cummings. She is a manager or a director with our accounting methods team and sits in Charlotte, North Carolina. She's going to be talking a few things about to-dos before year end with methods, and then also some questions to ask yourself and your business that applies to her area. So Brittany, welcome.
Awesome. Thank you, Iris. And thanks again to each of you for joining us today. In the next 8 minutes is what we've been given. I am going to kind of talk through a few accounting method action items and opportunities, give some examples to get the wheels turning, and really help us prepare to wrap up for 2024. And so before we dive in, let's start with just understanding what is an accounting method and how these methods are integral to a business's tax position. And so an accounting method is the tax methodology adopted for the timing of recognizing income and expense in a tax year. Said differently, accounting methods determine how businesses can defer or accelerate income and manage the timing of deductions. And so our UCX goal, or unmatched client experience goal, is really centered around analyzing each business to help them identify methods that can both mitigate risk and uncover opportunities. One instance or example, our team is currently working with a client to adopt a method for the timing of including rental income in their tax return. This opportunity is projected to save the taxpayer several $millions. And we came in, we reviewed lease agreements, analyzed the timing of receiving payments, and just took time to understand the current tax method to really help us uncover this opportunity. Oh, just realized I didn't have the awesome UCX slide. So there we go. All right. And so secondly, as Iris mentioned, just kind of some action items. And hopefully everyone has a pen and paper, jot down some notes. A few actions that we encourage businesses to consider before December 31st, especially for our calendar year taxpayers, is determining if a non-automatic or advanced consent method change should be filed in the tax year of change. Some common examples we see are related to non-small business taxpayers that are eligible to adopt the overall cash method of accounting. In September, we met with the business looking for cash tax savings, and the business has historically filed using the accrual method. However, after a few strategy meetings, we were able to determine that adopting the cash method would be more favorable for them. So we shared the guidance for the cash method for the non-small business taxpayers and are currently drafting a memo to support their qualification. And since the taxpayer is a calendar year filer, we must file that consent change again before December 31st, 2024, in order for them to utilize the cash method on their 2024 tax return. We've also seen a few accrued service contracts, and one we've seen a little more frequently lately is the adoption of the percentage of completion method for long term contracts. Last year, our team was successful in obtaining consent for a business to adopt a permissible long term contract method, which is 460. And we had previously identified research and development costs that were potentially subject to capitalization under Section 174. However, we were later able to determine that these costs could be excluded from Section 174 for 2023 due to the interaction of the long term contract and Section 174 rules. So, in this instance, the advanced consent change in 2022 paved the way for us to pursue a position around long term contracts with Section 174 costs in 2023. So if you are a long-term contract taxpayer, reach out to us and we can strategize on your business's Section 174 impact. And then I'm sure a few of you are thinking, hey, Brittany, how do I know if I have an advanced consent change due by 12/31/2024? Real simple. If you are a calendar year taxpayer considering a method change, just reach out to your tax advisor for guidance on timing of filing. But of course, loop us in and we can help as well. The second kind of potential follow up that we should keep on our radars for action before the end of the year is considering updating our internal policies to fix certain liabilities. The best example is related to bonus plans. So a lot of us are probably having our policy meetings or end of year budgeting meetings and having these discussions. And so bonus plans that generally create a legally enforceable right to the bonuses can be deducted in the year services were rendered, depending on timing of payment, of course, and a few rules. But if you have bonus plans that eliminate the bonus or the bonus is no longer payable if the employee is not employed on the payment date, these would generally not be considered fixed and therefore would be deductible when paid. Again, our team can kind of go through policies and have discussions with management to help identify any of those opportunities. And then lastly, to kind of wrap up the accounting method section, as businesses prepare for their year-end tax planning meetings with their tax advisor, we also encourage you to consider a tax methods review. And a methods review just involves documenting your current tax methods to verify their permissibility. And it also provides an opportunity to identify planning strategies that could have an impact on cash flow. And so, kind of continuing down the considerations list, businesses that are no longer small business taxpayers may have multiple methods to adopt in the year the average gross receipts threshold is exceeded. We actually met with a client yesterday who is no longer going to be considered a small business taxpayer for 2024. And so, in addition to adopting the overall accrual method as required, the taxpayer will also need to adopt permissible inventory and unit cap method. So, our team can help make sure the method is going to be correct, but also a good opportunity for the taxpayer. And so next up, I think, yep, on the list, while we are often focused on US taxes when we consider accounting methods, we can also strategize from a global tax perspective. And this includes considering method changes through controlled foreign corporations and how the timing of recognizing income or expenses can impact the ability to claim foreign tax credits or the impact that it has on the GILTI and FDII deduction. And then there's also a little interplay with controlled foreign corporation accounting methods with the new Pillar 2 guidance as well. And so just to conclude, we encourage you all to just reach out to us during our initial meetings and touch points with the methods teams. With the methods team, we'll understand your business, talk to you about your cash flow needs, and just really strategize on how methods can help.
Great. Thank you so much, Brittany. I really appreciate your time. Again, her contact information is up there and will be available for you if you'd like to talk with Brittany more. So next up, we have our R&D section. Mike Boenzi is a partner out of Chicago. He's going to talk a little bit about what action items you should take and implications of the new changes to the Form 6765. So, Mike, want to take it away?
Sure. Thank you, Iris. I appreciate it. And good morning, good afternoon, everyone, depending on what time zone you're in. So over the last few years, there has certainly been no shortage of developments in the R&D credit space, whether it be the chief counselors and requiring the inclusion of extensive details supporting their amended return claims credit, or the Section 174 capitalization rules prohibiting the immediate deduction of research and experimental expenses, or even the stream of noteworthy court cases have raised the bar on key issues that taxpayers have to be prepared to substantiate in claiming the credit. However, none, in my opinion, have the potential to be more significant than the proposed changes the IRS intends to make to Form 6765, which is the form that is required to be included in taxpayers' returns claiming the credit. Over the next several minutes, we'll provide a brief overview of the proposed changes and why they will have a reverberating impact for all taxpayers that wish to claim the credit on a go-forward basis. So on September 15th of last year, the IRS issued a preview of the proposed changes to Form 6765, which we'll call the preview form, and requested taxpayer feedback. And as you might expect, a significant number of stakeholders provided that feedback to the IRS. And then on June 21st of this year, via a press release, the IRS released a revised draft Form 6765. Now, consistent with the preview form that was released in September of last year, the revised form adds a new Section E with 5 questions seeking information on the following items. The first is the number of business components generating the taxpayer's claim for credit, the amount of officer wages that are included in wages for qualified services. The IRS is also looking to understand whether taxpayers have acquired or disposed of any major portion of a trade or business. And unfortunately, as of now, we do not have clear guidance on this item. Hopefully, when the instructions to the form are released, it will help to clarify a number of lingering questions that exist. For example, if a taxpayer owns 25% of a business in the first year and then acquires additional ownership such that it pushes the taxpayer over the threshold for a controlling interest, does that constitute an acquisition? Or alternatively, if a taxpayer acquires 30% of a business, does that constitute a major portion of a trade or business, even though the acquired business is not considered part of the controlled group? The next item the IRS is looking to understand is whether taxpayers identified any new categories of expenses in the current year qualified research expenses. So again, there's no explanation as to what new categories of expenditures mean, and hopefully this is going to be clarified in the instructions to the form. Some of the lingering questions that you might be asking are, well, if I incurred wages with respect to a particular business component in the past, and now I've incurred both wages and supplies, is that a new category of expenditures? Similarly, if the qualified expenses in the base years only include wages as an example, and now in the current year I incur contractor costs, is that a new category of qualified expenses? Or still even Further, do we evaluate the issue with respect to total qualified research expenses or on a business component by business component basis? And then finally, the IRS is looking to understand whether the taxpayer followed and derived any of its qualified research expenses following the ASC 730 directive. The revised form added a new section G titled Business Component Information. This section really comprises the bulk of the new information that is required by the revised form and will likely be the most challenging section for taxpayers to complete just from a time and effort perspective. While the revised form will be applicable for the 2024 tax year, the press release indicates that section G will be optional for all taxpayers in the 2024 tax year, but mandatory for 2025. Now, this section will require taxpayers to report 80% of their total qualified research expenses in descending order by business component, but no more than 50 business components will need to be documented. The press release also indicates that there will be special instructions for taxpayers using the ASC 730 directive who can report ASC 730 qualified expenses as a single line item. Now, this section G will also require the following information for each business component: the business component's name. The IRS also wants to understand what type of business component is it. Is it a product, a process, computer software, etc.? If the business component is computer software, then the IRS is asking taxpayers to identify the category of software. For example, is it internal use software? Is it non-internal use software, or maybe even dual function software? Or is the software exempted from internal use treatment? Section G is also going to require a description of the information sought to be discovered. Now, until the instructions are published, it's not entirely clear whether this description will be required for claims for credit on original returns. The revised form's press release seems to indicate that the IRS eliminated the narrative requirement that describes the information that sought to be discovered. This leads us to believe that this will only be required for amended return claims for credit and not original return claims. In addition, Section G is asking taxpayers to disclose their wage qualified research expenses by business component and further break that out by direct research, direct support, and direct supervision. And then finally, the IRS is asking taxpayers to break out their supply cost, cloud hosting expenses, and contract research expenses by business component. Now, as mentioned previously, while Section G is optional for all taxpayers for 2024 and mandatory for 25, Section G will always be optional for the following two categories of taxpayers, even after 2024. The first category is qualified small business taxpayers, which are companies with no more than 5 years of revenue and less than $5 million of gross receipts in the current year, who check the box to claim the payroll tax credit. And then the second category is taxpayers that are claiming credit on an original return and have qualified research expenses equal to or less than $1.5 million, determined on a control group basis, and gross receipts equal to or less than $50 million. Now, one additional note I want to make here is that there are no exceptions to this if a taxpayer is filing an amended return. Section G will always be required in those instances, and taxpayers will have to comply with the requirements of the Chief Counsel memo in that circumstance as well. So as you think about year-end planning with your teams, I think it goes without saying that these form changes are going to fundamentally alter taxpayers' approaches to gathering data and information in support of the credit. And for many are going to potentially require process changes, planning, and a proactive approach to gather the information that's necessary to satisfy these disclosure requirements, as well as potentially teaming with a knowledgeable and experienced service provider. Now, in order to prepare to address the requirements of the revised 6765, we would recommend taxpayers consider maintaining a detailed project list throughout the year with your engineering teams, updating it regularly with project activity details, as well as adopting perhaps some form of time or cost tracking system in order to connect people and costs to projects. Certainly beginning the R&D credit analysis earlier to allow extra time to gather the newly required qualitative information would be prudent in this case. We would also recommend potentially even whiteboarding your current R&D credit analysis process and determining where the gaps lie relative to the requirements of the revised form. And look to implement a methodology in the 2024 tax year that complies with the newly requested information in Section G in order to prepare for 2025 when this information will in fact be required. And also, we'd encourage you to include the Forvis Mazars R&D credit experts in any tax planning conversations for the upcoming year in order for us to collaboratively work with you to develop a plan. We have included snapshots of the revised form as well as a link to access the form on the IRS's website. If you have any questions or need assistance, please do not hesitate to reach out to a professional at Forvis Mazars. What used to be a relatively simple form will soon become with required attachments to be included with original return claims for credit. Now is certainly the time to prepare for these changes. And so with that, I will go ahead and turn it over to Lisa to discuss opportunities in the repairs and maintenance space. Lisa?
Thank you very much. I appreciate it. Hopefully everybody can hear me. I'm Lisa Petitella. I'm part of the cost segregation group. My home base is the Long Island office, so I'm in the Metro New York area, but we have consultants all over the country. And we're going to be talking today about repairs and maintenance studies, and this is definitely not a new topic. But what we are seeing in the accounting world right now is, especially with bonus depreciation coming down from 100% in 2022 down to 60% in 2024, a lot of taxpayers who own real estate are looking for other opportunities to find some tax savings. So that's why we're going to address this topic. We basically want to call it a refresher because it's been on the books since 2017. Well, it's been on the books for a long time, but it was updated in 2017. And we want to make sure that you guys are taking advantage of these opportunities to offset your taxable income. Where you start on repairs and maintenance studies is you have to determine whether an expenditure can be classified as a repair or does it need to be capitalized. That's always the question. The rules that came out with the TPR in 2017, I believe it was, sought to clarify these rules. So that's important to keep in mind. They didn't change the rules. They just sought to give you better bright line test. So some of this is kind of the workflow that you can do to determine these things. You start with, can the rules be applied? Does the safe harbor rule apply? Are they materials and supplies? Is it routine maintenance? What is the unit of property? And does it fail? You want to fail the bar test. Okay, so basically this is the basis in law, which basically means that you have to capitalize things, but you mostly have to capitalize expenditures, but there are situations where you can write them off as repairs, and they're written off in the year that they're incurred. Capital expenditures are depreciated over their useful lives. So you have to distinguish between those two things, and that's the premise of these types of analysis. Again, reinforcing in 2013, the IRS issued so it's 2013, sorry, it wasn't 17, where the TPRs, where these regulations sought to clarify the rules. And again, that it's important to note that, that they were just clarifying the rules. They didn't make new rules. The reason why that's relevant is because you can actually look backwards on these studies, because it's something that existed in the past. It's just a way of clarifying how you interpret the rules. When they apply, if the taxpayer made improvements to an existing property, renovations, or they refresh their space, a repairs and maintenance study can be done. A couple of very, very important things we want to keep in mind. If you build something new, there is no opportunity for repairs because you aren't repairing anything that you already owned. It sometimes gets convoluted there, especially when you already own a building and you do an addition. So I just want to clarify that. And that's what we're saying here, is that sometimes you do both. So so an understanding of the scope of the work is very important. And again, I'm reinforcing that the existing rules didn't change. And what that does is that opens up the opportunity to look backwards. And taxpayers typically will look backwards and collect any missed repairs and maintenance that they could have written off in that current year versus capitalizing via Form 3115 and a 41A adjustment. So that's how we're able to go backwards and collect that, which is a pretty easy way of doing it. You could also amend, but most people do it that way. So the safe harbor rule, this is a great one. And this is where we typically will start on repairs and maintenance studies when clients are looking for opportunities and maybe missed opportunities in the past. If you do keep good records, you can probably write some things off pretty easily, even though there may be you may have an invoice for something that's $6.2 million worth of purchases of computers, but if you have an invoice that breaks it down into 5,000 or 2,500, depending on your situation, you should be able to write that off as a under the TPR. So that's something to keep in mind, and that's something that we look for first. All right, materials and supplies, I put the bullets up here. It's basically, if you just go through these bullet points, you're going to look for things like non-incidental materials and supplies when they're consumed unless it's used in a capital improvement. So these are just things like cleaning supplies and things like that. You want to make sure that you're writing those things off as business expenses versus capitalizing them. Is it routine maintenance? These are good examples. These are examples from the IRS's website. Basically, if you can establish that you routinely will be repairing items that may appear to be capital improvements, you can write those off as routine repairs and maintenance. Okay, so once you get through those first couple of tests, where the fun begins is when you get into, all right, you're still in the capital bucket. Right now, you didn't meet any of those other requirements. And when you get into this to the category of now what do I do? You have to establish, you have to look at whatever your improvement is by its unit of property. And this is really important to understand so that you can apply the bar test. And again, as I said earlier, you want to fail these tests. A unit of property consists of all the components of a property that are functionally independent. And basically the IRS breaks them down this way. So they're improvements. And then within the improvements are manufacturing equipment, building and leasehold improvements, and other tangible property. Once we get into the building piece of that, and this is where we can find some repairs and maintenance, is you have to look at the building under its systems. And this was something that was added, in the 2013 regulations. And they basically say, these are establishing where your starting point is in applying the bar test. So for HVAC, you look at the motors, you look at the boilers, you look at the furnace. So you do have to have an understanding of construction in order to know whether or not you can capitalize or expense certain improvements. A unit of property for a leaseholder is its lease. I'm not going to get into it too much, but here it is. You can read that. But if you do leasehold improvements, your entire lease is your unit of property. You don't have to break it into the systems as you saw before. So other tangible property consists of one unit of property. And I'm really trying to highlight this for you because this is where a lot of the stuff, when you do a cost segregation study, the other tangible property is ultimately where we will classify these items, things such as removable floor covering, electrical systems for qualifying equipment. Once they're classified as this, they are their own unit of property, and it's a little harder to classify something that gets moved into a shorter class life as 1245 property. It's harder to fail the bar test because it is its own unit of property. Instead of just being the electrical systems in the entire building, you're only talking about the electrical systems for that piece of equipment that made it qualifying. So it is important to segregate out these expenditures for audit worthiness. You don't want to keep these in your electrical systems and then say, you want to know what the overall project was, just a minor replacement of the electrical components. Whereas within the electrical, there were things that actually were their own unit of property. So it's really important that you do the 1245, 1250 segregation, which is what cost segregation studies do, before you commit to writing, determining whether the entire system is an expense. Okay, so now back to the bar test. Now that we've established what the unit of property is, so essentially, you apply the bar test to the unit of property, and those unit of properties are what we just discussed. The bar test comes from the acronym. It's a betterment to the unit of property, it's an adaptation to the unit of property, or it's a restoration of the unit of property. You do want, your goal is to fail the bar, unlike a lawyer. Okay, and then this just kind of goes through the list of the various definitions of betterments, adaptations, and restoration, and where we find where we are brought in to help out taxpayers is in the restoration piece, and the highlighted part here, which is where when a taxpayer replaces a major component or a substantial structural part of a unit of property, that's where we find we can write off some of the improvements that people do, and put them in as repairs versus having to capitalize these. Here's some examples of adaptations. You can deduct when you do a refresh. You do cosmetic layouts, repainting, as opposed to when you're replacing large sections of walls and windows, rebuilding interior and exterior facades with updated materials. These are the two buckets under the adaptation examples. This is just an example, amount paid to adapt the unit of property to use of that's non-consistent with when the time they place it in service. This is a good example of this is when, and this is happening a lot right now, where let's say you buy an office building and you convert it into a residential rental, which is happening in New York City right now. The repairs and maintenance studies are off the table. So building restoration and replacement examples. So this is where, like I said, we find a lot of property that you can probably move to repairs if you really dig into what's going on. And again, it takes just an understanding of the construction process and what makes up the components of what is being changed. The rule of thumb that we use, and this is through the TPR, is that 40% or more of the operational system is replaced, you capitalize it. If a substantial structural part, 30% or more of the physical structure is replaced, you capitalize it. And below here, we're giving you some examples of what that means, and some real life situations that we've run into.
Oh, great. Thank you so much, Lisa.
I didn't realize I came to the end. Thank you.
Yeah, no, thank you so much for your time. I think we're going to move right on along to Katie Simmons, who is both a senior manager with our controversy group, as well as the firm's leader of our aviation practice. So Katie, want to take it from here?
Thank you, Iris. Yeah, so I'm actually sitting in Las Vegas, Nevada today. I'm here for the National Business Aviation Association's annual conference, and the tax people have been really popular this year, which in a private jet event is not usually the case. But I've got the IRS to thank for that, and we'll talk a little bit about why. All right, so in February, the IRS announced a new campaign focused on business aircraft. Joe Biden in the State of the Union address talked about cutting corporate jet loopholes. There's talk of changing the depreciable life of airplanes, changing how income is treated for personal flights. So this area is definitely in the crosshairs. And if your company has an airplane or is considering purchasing one, you really need to be prepared for some additional scrutiny that's going to be coming your way. So when we're looking at the income tax issues related to business aircraft, they really fall into three buckets. The first is going to be qualified business use. So qualified business use is a test that you're going to perform annually to make sure your airplane has enough business use to qualify for accelerated depreciation. So this includes bonus depreciation as well as makers. And it doesn't just come into play in the year of acquisition. You're going to test it for 6 years post-acquisition. What happens if you fail this test and fall below the threshold is the IRS requires you to go back and recapture accelerated depreciation you took and convert to the straight line method. Obviously, nobody wants phantom income, so it's a very important area to be properly managing and keeping an eye on so you don't have that unexpected income. Another issue is related to personal use of the business aircraft. Anytime you have personal flights, there's some fringe benefit issues that you need to be thinking about and including that income in the individual's compensation. And then lastly, entertainment. Entertainment is a non-deductible expense. So if you have business entertainment flights or personal entertainment flights, you're going to have expense disallowance associated with that. So if you get this exam notice from the IRS, what are you going to be having to hand over? So the first thing they're going to ask for is information on who owns the airplane and how that entity is related to the taxpayer. Certain ownership structures come with more restrictive qualified business use rules. And this is why it's so important to get your tax advisor involved when you're considering a purchase of an airplane. You want to make sure you have a structure in place that's going to set you up for success and give you the most flexibility in terms of deductions. Of course, they're going to want a depreciation schedule. They're also going to want information on all the passengers who were on board. There's certain special rules that apply to these categories that we call specified individuals and control employees, as well as 5% owners and any family members of these people. So they're going to request that listing, and they're going to want to make sure you've accounted for all those special rules in your calculations. They're also going to ask for copies of meeting minutes that discuss the airplane. They're going to ask for an aircraft use policy, which I often do not see clients implementing. That's a very good business practice, and it also helps us kind of prove to the IRS that we've really thought through how we're going to use this airplane to conduct our business. They're going to ask for management agreements, dry leases, purchase documents, things like that as well. All right, so all of our calculations really hinge on the passenger level and the flight detail. So something that's really critical in these exams are the flight logs. These logs need to have the date of the flight, where the flight left from, where it landed, the statute miles, not the nautical miles, as well as the time of the flight. So pilots can gather all this for you, but the last piece we're going to talk about is where you really need to have someone from the business helping you document and gather information. So you need to keep track of every passenger on every leg of the flight and why they were on board. So you can have maybe a flight for a business meeting, but maybe a spouse attends and that person's there for personal entertainment. You have a child on board who's going back to college. That's considered personal non-entertainment. So when we're keeping flight logs, we need to keep a description of what the flight was for, and we need to identify if anybody was on board for a different purpose. Then we need to keep documentation that supports that description. And it's very important to have contemporaneous documentation. So if you have a business flight, we need to be keeping emails that talk about an upcoming meeting, calendar appointments, meeting minutes, agendas, copies of presentations, maybe a contract was executed at that meeting, a copy of the signed contract. So in your business, you need to identify the best person to gather this information. A lot of times it's an executive assistant, but you need to implement a system where they are gathering the documentation as flights are being made and filing it and getting yourself ready in the event of an audit. So if you have any questions about what sort of documentation would support your business flights, please reach out so we can help. Lastly, they're of course going to ask for the calculations and make sure you've properly accounted for them on your return. So some final tips and tricks: make sure you're keeping information about all your passengers. Make sure your flight logs are comprehensive. You've dealt with maintenance flights, training flights, and those unoccupied deadhead flights. Document, get a good system in place and follow through with that system. And then lastly, make sure you're doing the calculations correctly, taking advantage of items that can benefit your company, and reaching out to me if we can help you get these calculations done. So that's the world of audits, Iris.
I love it. Thank you so much, Katie. It's a whole different world that I'm aware of. So appreciate you being on here today, and feel free to reach out to Katie with further questions. So next we do have Troy Taylor. He's a partner out of the DFW Dallas area. He is the leader of our Inflation Reduction Act and Clean Energy Tax Credit practice. So gonna go ahead and kick it off to you, Troy.
Awesome. Thank you, Iris. I'll try to make this relatively brief so we can kind of catch back up from a time perspective. But my contact information is in the slide deck. If you ever have any questions regarding IRA, please just reach out. Happy to get on a call and talk about it. So the IRA Act, it extended a number of energy related tax credits and incentives, but then also created a number of new ones as well. And, think solar panels, geothermal heating systems, battery storage, those types of opportunities or projects that you might be installing. But then the IRA also made some really good changes to the way those credits are administered. One of them being a lot of them are now transferable and sellable. And so if your entity doesn't have the tax appetite in order to claim those credits, you'll then be able to sell them in the open market and still be able to get some value out of that. Nonprofits and governmental agencies are also able to take advantage of the program. They can receive a direct pay refund of those credits. So the way that most of the credits work is there's a base credit, say 6% of the total spend is one of the examples, like in the investment tax credit. And then there's an opportunity to increase that percentage based on if you meet certain criteria of different bonus credits. We're not going to get into all of them by any means, but there are a number of them out there that you're able to increase the credit amount for. The biggest one is this 5 times bonus credit, where there's 2 ways to meet it. And if you do meet it, it's 5 times that initial 6%, which would then get you up to the 30% that the ITC was before the IRA was created. You can either meet the 1 megawatt exception, which means your project is below 1 megawatt of energy output. That's to give you some frame of reference there. That's between 2,500 and 5,000 solar panels. So obviously a very large project at that point would be the 1 megawatt. If you are over that, you have to meet what's called the prevailing wage and apprenticeship requirements. So you're going to have to pay a minimum wage that's established by the local government authorities there to the workers. And then if you have at least 4 workers, you have to have an apprentice on site in order to learn that trade. These are just some of the example bonus credits that you could possibly receive. We're not going to get into them from a time perspective, but obviously an additional 10 or 20% credit on your spend can mean the difference between going forward with the project or not going forward with the project. So it's really important to evaluate these on the front end, because some of them you have to apply for, or you want to make sure you include language in your contracts with your contractor to make sure that they are complying with their side of getting these bonus credits as well. The 2 most common types of credits are the Section 48 investment tax credit, Section 45 production tax credit. 2 very different credits calculated very differently, but oftentimes you can choose either or of these credits on the same spend, but you can't claim both at the same time. So you have to do an analysis and determine, Is the investment tax credit, which is based on the spend, better for you? Or is the production tax credit, which is a smaller amount on an annual basis, but it's over a 10-year period of time, is that one better for you? So you need to do a cost benefit analysis and determine which would be better for your organization. Here's a basic example on how the credits operate. This one's about a solar installation for ITC. Pre-IRA, it was capped out at 30%, but then post-IRA, you'll see that it has a 6% base credit, which doesn't really move the needle in a decision-making point of do you want to go forward or not. But it can quickly get back to that 30% with the 5 times bonus, and then increase to 50 or 60%, depending on what the additional add-on bonus credits are. So really important to do a full evaluation and understand what the real spend is there. Okay. 179D has been around for a long time, but the IRA definitely made it more advantageous. And so what this is, if you're doing energy efficiency improvements to an existing building or to new construction of a certain percentage, you can receive a $1 up to $5 per square foot deduction for those improvements that you're making. The IRA made a couple other really important changes, like it made this deduction permanent, and then also changed it from a lifetime cap on the building to an annual cap, so you can do multiple projects on the same building potentially. We don't need to get into the details from an electric vehicle standpoint. They're relatively self-explanatory, but these are important if you're redoing your fleet of vehicles. Take a look at this, give us a call. One thing to note on the charging station credits, you do have to install the charging stations in a non-urban area or a low-income area. That surprises a lot of people. They think they can just get the credit. Okay. Also in the slide deck, there is a link to Tax Cred Pro for clean energy. It's just a questionnaire. You can go on and fill in some basic information, and it will send you a PDF that shows what types of credits you could be eligible for, and just help you in that decision-making process. Probably the most important thing you can get out of this very short IRA presentation is get your trusted tax advisor involved early, because some of these credits you're not going to be able to claim if it's not included in the contract with the contractors and if you don't apply for them. So you want to make sure that you're keeping them in the loop. All right. Thanks, Iris.
Love it. Hit all the high points. Thank you, Troy. So next up, we're transitioning into our state and local topics. We have Dave Landwehr with us. He's a salt manager out of our Kansas City, Missouri office. So Dave, want to head forward with that?
Absolutely. Thanks, Iris. So I'm going to be discussing Public Law 86272. So first, very quickly, what is Public Law 86272? It's a federal law from back in 1959 that protects certain sellers of tangible personal property from a state net income tax if their activities in a state are generally limited to solicitation and sales of that tangible personal property. Very important here that it only applies to those sellers of tangible personal property, and it only applies to a net income tax. It doesn't apply to franchise taxes, doesn't apply to gross receipts taxes, sales tax, anything like that. So the MTC is the Multi-State Tax Commission. It's an intergovernmental agency made up of representatives from each state's Department of Revenue, and they come up with model statutes and kind of give opinions and statements on many different things in the state and local tax world. And one thing they have is a statement on Public Law 86272. It lists activities that they deem to be protected by 86272 and activities that they deem are not protected by 86272. So in 2001, they updated that statement to include activities conducted via the internet. And included in their unprotected activities, they have items such as providing post-sale assistance to in-state customers via electronic chat or email on the business website, and receiving online applications for a branded credit card, inviting viewers in a state to apply for non-sales positions. So that's pretty aggressive. If your business has a website that has a careers page, which with openings for non-sales positions, the Multi-State Tax Commission says, yep, that breaks your protection from Public Law 86272. Also included, they have placing internet cookies onto a computer and using those cookies for non-sales activities. And they have offering and selling extended warranty plans. So something to kind of put this in a little bit of context here is that Public Law 86272 protects you from solicitation of those sales. And so as you can kind of see from this activity here, the MTC is really kind of going after activities that are either post-sale or not really related to that sales process whatsoever. There are a couple states that have taken the MTC's language and apply those. California, New Jersey, and New York have done this. They've done it in kind of different ways. New York's regulation is being challenged in court. That is American Catalog Mailers Association versus New York. So that's something that we're certainly keeping an eye on. And then also Congress, there is one little bill in Congress that kind of changes the definition of solicitation for 86272 purposes. But I would not expect a whole lot of action from Congress, especially in the near term, as they are all focusing heavily on the election coming up. So in summary, what we expect to see in 2025, we do expect to see more states kind of adopting this language in various ways. We do not really expect a lot of action from Congress. However, you never know. It's certainly possible. What your business needs to do if you are a seller of tangible personal property is monitor these updates. Talk to your Forvis Mazars advisor to see what's going on. See if you need a quick study here, and kind of monitor your state from a physical presence activity, but now also understand what activities you are conducting via the internet. And now I will pass it back to Iris.
Great. Thank you so much, Dave. And last but most certainly not least, we have Kayla Wall, also a SALT manager. She sits in Charlotte, North Carolina. Want to bring us home, Kayla?
Yes, Iris, thank you. I'll hopefully get through this quickly. So yeah, today I'll be giving a brief update on the recent case coming out of California that deals with apportionment. So the facts of the case are as follows. Microsoft was a Water's Edge filer and received foreign dividends from a foreign subsidiary. Microsoft included these foreign dividends in the income tax base and deducted 75% of the foreign dividends utilizing the dividends received deduction provided by the statute. On the original return, Microsoft had excluded the dividends from the sales factor denominator when calculating its apportionment percentage. And then Microsoft filed an amended return and included the gross amount of the dividends in the sales factor denominator, which in turn diluted the apportionment percentage and reduced the amount of tax due. So then Microsoft requested $94 million in refunds due to the change, and the California Franchise Tax Board denied the claim for refund, and Microsoft appealed. In the Office of Tax Appeals opinion, they agreed with Microsoft and looked to the plain language of the statute. And more importantly, they refused to give deference to a ruling by the California Franchise Tax Board that dealt with the same provision. So the Office of Tax Appeals used its independent judgment and ruled that even though the dividends were excluded from the income tax base, they could still be included in the denominator for the sales factor apportionment formula. the California Franchise Tax Board did file a petition.
All right, it looks like we might have lost her. I apologize for the technical difficulties there. I think Kayla is in a league of her own when it comes to these topics, so neither of us are going to be, neither Dave nor I are going to be able to step in there. But all of that being said, you will have access to the slides and the recording following this call. So we really appreciate your time. I'm going to go ahead and skip forward to our last polling question. I know that's a big thing for all of us. So if you could go ahead and indicate whether you'd like to be contacted by one of our presenters today, that would be great. And all of that being said, we just really appreciate your time today. We have a few further sections of our series for year-end planning. We have international tax and then private client coming up here in November. So be sure to take a look out for that. And again, if you have any questions at all, please feel free to reach out. We're happy to schedule some time for you guys. And yeah, thank you again.